At Insightful Value, we don't chase hype. We hunt for solid companies hiding in plain sight. And Sonoco Products might be one of them. The stock is down, but the business still packing a punch. This review is for informational and educational purposes only. It is not financial advice. Sonoco is a global packaging company with a surprisingly diverse portfolio. They make everything from industrial tubes and cores to consumer packaging for food, personal care, and medical products. If you've ever bought snacks, shipped something, or opened a can of soup, there's a good chance you've touched a Sonoco product. They operate in more than 30 countries and serve a long list of blue-chip clients. So, what's going on with the stock? After a strong run in 2021 and 2022, Sonoco's share price has fallen sharply over the past year. Weak industrial demand, inflation pressure on input costs, and a slowdown in consumer spending have all weighed on results. Revenue has slipped and earnings have softened. But this isn't a company in trouble, it's a company in transition. Sonoco has been reshaping its business, focusing more on high-margin consumer packaging while exiting lower-growth, less profitable segments. This strategy helped lift margins during the good times, but in today's slower economy, those gains are harder to sustain. Still, the company remains solidly profitable. Operating margins are hovering in the low double digits, not bad for a mature manufacturer. The balance sheet is stable. Debt is manageable, and cash flow remains positive. Most importantly, Sonoco has a long history of paying and growing dividends. Over the last 40 years, they've raised their dividend almost every single year. Right now, the dividend yield is attractive compared to historical levels, and the payout ratio remains conservative. This signals confidence from management and suggests that even in a downturn, investors can count on consistent income. From a value standpoint, the stock is now trading at a discount to both its historical average and its industry peers. The market seems focused on short-term headwinds, not the company's long-term durability. Sonoco is a 125-year-old business. It's seen recessions, wars, inflation cycles, and technological shifts, and it's still here. That says something. Now for the risks. The packaging industry is sensitive to macroeconomic cycles. When manufacturing slows or consumers cut back, demand for packaging drops. Sonoco's earnings can be lumpy. Also, input cost inflation, especially resin, paper, and energy, can squeeze margins if not passed on to customers. Environmental concerns and regulatory pressures around plastic and packaging waste are rising too. And while Sonoco is making moves in sustainability, it's a long game. Why consider investing now? If you believe in mean reversion and long-term cash flow stability, Sonoco is a strong candidate. The current price may reflect temporary challenges, not permanent damage. It's the kind of stock that could quietly deliver steady returns, especially when reinvested with dividends over time. Why stay cautious? If you think global growth will stay weak or raw material inflation will persist, then Sonoco could remain under pressure. This isn't a growth rocket. It's more of a slow, sturdy machine. At Insightful Value, we deliver deep, no-nonsense analysis of companies like Sonoco, businesses with real operations, real earnings, and sometimes unreal valuations. Whether you're new to investing or a seasoned value hunter, our approach cuts through the noise and brings the story to you straight. You can find more detailed reviews like this one on insightfulvalue.com. If you like this breakdown, give it a thumbs up, subscribe to the channel, and check out insightfulvalue.com for more clarity in your investing journey.